And RBC's top bank analyst thinks the bank rally might be in its early innings. Gerard Cassidy's co-head of Global Financials Research, a multi-year top-ranked analyst by Institutional Investor. Gerard, great to have you. What do you think is driving some of this price action, at least the past couple of days?
Thank you for having me on the show, Carl. I think one of the biggest drivers here is the expectation that the Federal Reserve, its next move will be to cut short-term interest rates through the Fed funds rate. We saw it today with Bank of America. They were talking about the second quarter is likely to be the low point for their net interest income. PNC, which is a big regional, reported today. They showed the inflection in net interest income this quarter. As you know, anywhere from 55 to 65% of most banks' revenue comes from net interest income. So that, I think, is the big driver and the expectation that the Fed's going to cut rates over the next 6 to 12 months.
Gerard, it's Karen. Thanks for being on today. Do you want to be positioned to have more of a bet into a rebounding NII or to loan growth or better? Where do you think the sort of juice is in the next part of the move? That it's been an incredible move when you think about how much higher they were before earnings started, which usually makes for a very tough bar, and yet now they're even higher still. So where is the next sort of leg up?
No, it's a very good point, Karen. And I would say that the next leg up is going to be on more, I think, the regional banks, which have lagged the universal and money center banks. When you think back over the last 12 months, the largest cap banks have actually had the best moves relative to the regionals. But if it is true that the Fed does cut rates and you start to see the funding costs for these banks fall, while at the same time, the yields on their earning assets should increase because the cash flows are coming off of lower coupon assets being invested in higher coupon assets. For example, PNC did a restructuring of their bond portfolio. They sold off coupons of about 1 and 1.5% in the bond portfolio and reinvested it north of 5%. That's a huge pickup.
Gerard, loan loss provisions have been ticking up seemingly across the board, number one. Number two, for Bank of America, for example, which I didn't think was a great quarter, but okay, I get it. Right now, they're trading at about 1.27 times book. Their book value reported today was the same as last quarter, 34.40. Now, I get it. They're probably a better bank than Citi in terms of that metric, but they're probably getting a little long in the tooth historically as to where it's trading now. What are your thoughts there?
It's interesting, Guy. If you go back to the high watermark post-financial crisis on valuations, it's year-end 2017, early 2018. And that's where the banks, as a group, traded at 1.6 times book. Now, not all the banks traded there. Of course, Citi didn't trade there. Even Bank of America didn't trade there. But I still think there's upside. And to your point, when you start to see the bond portfolios mature, we have to remember that the book values and tangible book values are depressed because they have to take out the unrealized bond losses from those calculations. So the growth in book value and tangible book value for Bank of America and others will be much faster than earnings growth over the next 12 months, which tells you that even if they maintain the valuation, let alone see it expand, the stock should still move higher.
Gerard, I'm a firm believer that J.P. Morgan always got the Jamie Dimon premium. So you can push back on that if you'd like. But now when you're coming towards the end of his career or the final innings of his career, does that premium get pulled out? Because J.P. Morgan has underperformed, not by a large margin, but it's definitely underperforming. Is this a Dimon premium coming out?
David, you make a great point. There is definitely a Jamie Dimon premium. I don't disagree with you. I think part of the relative underperformance over the recent term has more to do with the risk on versus the risk off strategy. If you really believe we are in a soft landing, Fed's going to cut rates. To Guy's point about the provisions for loan losses, they start to stabilize or even may go down next year. Then you want risk-on bank stocks rather than the risk-off name like J.P. Morgan. So you layer that in with what you pointed out, the premium, which I agree with. He definitely contributes to the valuation of that stock. And the day he retires, the stock is going to trade down. Now, he's got a very deep bench, highly qualified people, but it's tough to replace him. Obviously, he's a one-of-a-kind CEO and has done a great job for J.P. Morgan.